Hi, it's Nick Trompf here. I'm Executive Chairman of Advance Cairns, and I've got with me today Shaun, the Director from Halpin Partners. We're going to have a bit of a chat around reporting obligations during COVID-19. Shaun, it's obviously a challenging time for business and industry at the moment, an unprecedented time. The end of the financial year is only just over a month away. What are some of the questions that people should be asking their advisors as they think about the year end and their reporting obligations?
Yeah, so Nick, thanks for having me, mate. Great to
Pleasure.
come along. I think there's two really key things with end of year financial reporting people need to focus on. One is around classification of debt and liabilities, and the second is around impairment of assets. So just in relation to liabilities, businesses will have on their balance sheet current liabilities, which are due and payable in the next 12 months, and non-current liabilities, which are due and payable longer than 12 months. Now, as a result of COVID-19, it may well be triggers have been set which is going to convert some previously non-current liabilities or long-term debt to be current liabilities. Examples might be a long-term loan agreement with the bank that because you failed a covenant may now become current. Other examples are around employee entitlement, so you might have long service leave or other liabilities that have been non-current or classified as being payable longer than 12 months. As a result of COVID-19, if employees have been stood down or made redundant, again, some of those liabilities may become current. Now, that may seem only a very small accounting, classification between current and non-current, but when you're assessing, the strength of your balance sheet, having a whole heap of debt being transferred from non-current to current, does substantially weaken that current asset position and could cause some issues for companies and businesses. So I guess that's number one. Second one is around impairment of assets, and so impairment is a term which means to assess the value of an asset, and if it's not worth as much as it was worth last year, it needs to be written down. Correct. So for a lot of businesses who aren't able to trade at the moment, the value of their asset potentially would be reduced, whether that's tangible assets, so boats, plant and equipment, fit outs, or non-tangible assets such as goodwill. And so in addition to not being able to trade and use those assets in the business to generate revenue, which would impact its value, the secondary market for a lot of those assets, would have dried up substantially as well. So boats are a really easy example, right? There's not a lot of people out there at the moment looking to buy
aeroplanes,
a whole heap of boats or aeroplanes. So I think, unfortunately both these have a bit of a negative connotation, but classification of debt and impairment of assets are going to be the two most important considerations for people this year when they're preparing financial statements.
So for businesses, revenue's been dramatically affected. They've been shut since March, which there are many. What's the likely flow and effect of that in terms of the way the financial institutions might look at their debt as they prepare to report?
Look, so ordinarily, if we just look at one business on its own, which the business had collapsed, it had it's failed its bank covenants. The banks may have in other circumstances come in and had a fire sale of business assets or taken some other action or try to secure some other collateral to secure its position. Obviously, we're not in normal times, so I don't really know what banks are going to do, and I guess we've got a period of time up until the end of September where there's government support and there's temporary release for insolvent trading provisions and creditor applications. So we're sort of probably dealing with in the short term a period of time where I don't think we'll see a lot of aggressive collection action happening. Once September comes and goes, and we're sort of, I guess, the rules are such a back to normal, we'll just have to wait and see. I couldn't see financial institutions or banks or just creditors in general, going and putting good businesses into liquidation with the chance of no recovery at all. But equally, if you haven't been paid a lease or a loan payment for 6 or 8 months, you're not going to do any. You're not going to sit there and do nothing either. So it's going to be interesting. I don't think anyone really knows what's going to happen, Nick. But it's that's certainly again just an area to flag. Classification of liabilities, impairment of assets, key things for businesses to be looking at.
Yeah. When it comes to auditing, they're likely to look at some disclosures and assumptions a bit more closely this year. A lot more focus. What are the sorts of activities businesses might need to disclose in their financial statements?
I think certainly there will be disclosure about the impact of COVID-19 will become a standard feature of most financial statements, whether it's mandated or not. I think users of financial statements, whether it's the bank or its creditors or shareholders, are going to want to know
You're
that.
going to look for that specific effect.
100%. Now, where there's some uncertainty in relation to a business's ability to continue to trade as a going concern, which again for a lot of businesses there will be that uncertainty, there need to be specific disclosures made in relation to going concern, in relation to support that shareholders, for example, may have committed to a business to keep them going.
Yes.
So, it's very, very difficult to be able to give you an itemised list of every disclosure that needs to be made, but I guess all the questions and all the questions and considerations that we're discussing in relation to businesses' values, trade, revenue, ability to continue to trade, all of those items are going to need to be disclosed in the notes. If there's been lease concessions or renegotiation of lease terms, that will be a disclosure as well. So we're going to see, a lot of information in the financial statements this year, and a lot of disclosures made that have never been made before.
And all this tells me that with just weeks to go until the end of the financial year, people who might be fearing going to get advice because of the cost actually is more important than ever in terms of thinking about, do I need to go and get some advice now in advance of when I might normally do preparation of statements?
Mate, 100%. And I guess, with this coronavirus, pandemic has accelerated very quickly from an economic perspective in Australia, and I guess liken it to a sprint. We're sort of at the end of the sprint now, but we've got the marathon of recovery ahead of us, and businesses might see that this year, for example, they've made $1 million loss because their operations have been disrupted. Once they then impair their assets, that might actually become a $2 million loss because they've had to write down some of the value of their business or business assets. So, I think businesses, that's going to be a bit of a scary process for people to go through. Yeah. But I think,
and book loss versus real loss as well will be the...
Exactly. I think people need to get on the front foot a bit, understand what that is, talk to their banks. Those who act first and have a plan, my feeling would be they will be better prepared for the recovery, as opposed to those who put their head in the sand and delay, and we get to that magic mark at the end of September. They're probably the ones who then are most vulnerable for some sort of collection action.
So Nick Trompf here, Executive Chairman of Advance Cairns, talking to Shaun, Donaldson, the Director of Halpin Partners. Shaun, government stimulus packages like JobKeeper and payroll tax deferrals, any tips around how you handle those in terms of reporting between now and the end of the year?
Sure, so I might just take two approaches on that one there. So first of all, from a tax position, so most of those grants will be taxable income, so you'll include those in your tax return. The exception is the cash flow boost that a lot of businesses would have got, which is effectively an offset of your PAYG withheld. That's non-assessable income, so that you don't need to pay tax on that. From a financial reporting perspective though, all of those different forms of government assistance are revenue, and you'd report them as other revenue in the financial statements, and if they're significant, disclose them in the notes as well.
Okay, they're pretty welcome for a lot of businesses, those benefits obviously, so they've been a positive in a really difficult time.
Yeah, mate, definitely. I think for a lot of businesses, they probably wouldn't have had a lot of other revenue to report the last couple of months apart from those government grants.
Yeah. So, hi, Nick Trompf, Executive Chairman from Advance Cairns. We've got with me Shaun Donaldson, Director from Halpin Partners. Shaun, as we get towards the end of the financial year with the COVID-19 challenges that we've got, are there any changes to sort of reporting deadlines or reporting requirements that businesses might need to be aware of?
Yeah, Nick, so probably the key change has been ASIC have granted an extension for unlisted companies, giving them an extra month to lodge their audited financial statements. So that extension applies to 31 December 2019 year end, so for companies that reported a financial year ending December 19, and extends all the way through till the 7th of July 2020. And the reason it's 7th of July, not the 30th of June, is some companies have a year end date at the end of a week, not a 30th of June. So pretty much anyone, so whether you've got a December or a June financial year end, if you're an unlisted business, you've got an extra month to be able to prepare, audit and lodge your financial statements with ASIC.
And that'll be some relief because there's obviously great uncertainty in the preparation of those financial statements this year anyway compared to a normal
year. Correct. So it'll be, on the one hand, it'll certainly give people, more time to be able to come to grips with what's happened and what needs to be reported and disclosed. And just from a practical perspective, I mean, a lot of people are still working from home. Auditors tend to spend most of their lives out of the office going and visiting business premises. That may not be possible at the moment because of restrictions on travel and social distancing. So it certainly is a welcome timeline to give everyone a bit more breathing space to sort out the practicalities around year-end reporting for this year.
And given the unprecedented nature of what we're in, I'd imagine it's going to be more complex for professional advisors like yourselves and the auditors and so on anyway. It won't be as straightforward as it might normally be. Is that a reasonable assumption to make?
Yeah, no, correct, Nick. It's quite scary, I think, for directors signing off on financial statements and auditors as well. We're seeing things move, so quickly at the moment. We just don't really know where we're going to be a month or two's time. So I always think, the more time you've got, the better you'll be able to assess what the impacts are, and the better you'll be able to reflect it in financial statements. If you'd signed off on financial statements for a business at the end of February, compared to now, we're only 2 and a bit months later, obviously those financial statements, the disclosures, the asset values would have changed quite considerably in a very, very small period of time.
Thanks.
Thanks, mate.